Welcome to this explainer. Today, we're diving straight into the wildly divided state of the global metals futures market as of July 2026. Right now, the commodity space is telling a really dramatic story about the health of the global economy. I mean, we're talking trillions of dollars shifting in real time, and the signals, well, they literally couldn't be more conflicted.
Here is our roadmap for today. We'll start with the overall market divergence, then look at gold as a safe haven, silver's dual-use status, copper being compressed for a breakout, the grim prospect for iron ore, and finally the upcoming signals to watch.
Part 1. Market Divergence, the Global Divide.
Just take a look at this data snapshot from July 23, 2026. This brilliantly illustrates the exact divergence we're talking about. On one hand, you've got precious metals flashing green. They're acting as robust geopolitical safe havens in a time of profound uncertainty. Capital is actively seeking shelter, right? But then, right alongside them, you see industrial metals absolutely bleeding red. These base metals, the actual building blocks of global infrastructure, are really struggling under a distinctly gloomy macroeconomic picture. A lot of this is heavily influenced by massive headwinds out of China, where property sector woes and sluggish manufacturing demand are just casting a huge shadow. So what we're witnessing here is essentially two totally different economic realities playing out on the exact same dashboard. Geopolitical fear is driving one side, and industrial slowdown is driving the other.
Section 2. Gold, safe haven. So let's cross over to the booming side of the market first. Gold futures have surged past the $4,130 per ounce mark. That's a two-week high, jumping over 5% since just last Friday. To put that into perspective, an absolute move of over $200 in just a matter of days is frankly staggering. For an asset class that's historically known for slow, steady, fractional movements, a 5% jump in such a compressed time frame is absolutely massive. It really highlights this fierce, institutional-level rush towards safety. Buyers are literally willing to pay significant premiums just to secure their positions. And you can see that sheer vertical momentum right here on the COMEX August 26 chart. Initially, this was fueled by Middle East tensions acting as a sort of launchpad. You know how it goes. When geopolitical risks escalate and the headlines turn dark, massive pools of capital instinctively flow into assets that have preserved wealth for millennia. Institutions just pull their money out of riskier equities and park it in gold to weather the storm. This sharp price recovery vividly maps out that fear-driven demand in real time. But actually, fear isn't the only structural force pushing these numbers up right now.
The real shockwave hitting the market is China's sudden move to ban paper gold trading tomorrow, July 24th. Banning paper gold, which basically means trading contracts backed by cash where no actual metal changes hands, forces physical settlement. This is a monumental policy shift on the Shanghai Gold Exchange. By eliminating retail paper gold, they are actively squeezing out speculation. If you want to hold a position now, you've got to source the actual physical bullion. Now, this might cause some significant short-term volatility as traders scramble to adjust or liquidate their synthetic positions, but make no mistake, it builds a rock-solid floor for physical gold long-term. Investors will now be required to hold the tangible metal, which is going to fundamentally drain vaults and severely tighten global supply.
Moving on to Section 3. Silver, dual-use status.
Let's look at the fascinating middle child of the metals market right now, silver. Silver is desperately fighting to hold on to the massive psychological threshold of $60 an ounce. And this number isn't just arbitrary, right? It acts as a historic, multi-decade resistance ceiling. When silver pushes against this level, it triggers massive algorithmic trading and deep psychological reactions from investors. At these levels, silver has essentially seen double the percentage gains of gold. But, as you might have noticed, it's experiencing a significantly bumpier, much more violent ride trying to maintain this altitude.
So why the bumpier ride? Well, it's because silver is currently caught in a fierce tug-of-war due to its dual-use nature. On one hand, investors buy it for geopolitical protection, treating it just like gold. But simultaneously, it's an indispensable industrial component. The demand from the manufacturing of solar panels, electric vehicle contacts, and advanced electronics is simply colossal. These technologies require massive amounts of silver paste, creating a severe structural supply shortage that constantly pushes the price up. Yet, its reliance on industrial health means if the broader economy sneezes and consumers stop buying EVs or financing solar projects, silver catches a cold. The overall trend remains deeply bullish because of that green tech deficit, but anyone holding it has to be prepared for some aggressive, volatile shakeouts along the way.
Section 4. Copper, compressed for breakout.
Moving over to the purely industrial side, let's check the global thermometer, often referred to as Dr. Copper. As you can see, copper has been stuck in a phase of tight consolidation, moving sideways as it lacks a clear catalyst to break out. In the financial world, this metal is universally known as Dr. Copper because it essentially holds a PhD in economics. Think about it. You cannot build a house, manufacture a car, or upgrade an AI data center without it. It's the ultimate diagnostic tool for the health of global manufacturing. Because copper is used in practically every sector, this sideways hesitation tells us the broader global economy is currently holding its breath, completely unsure of its next directional move.
But here's where it gets interesting. Despite the hesitation from U.S. tariff fears and weak downstream buying, meaning factories are currently purchasing less material for production, falling inventories and smelter cuts are compressing the price. This gives copper massive potential to break all-time highs soon. It's really like a tightly coiled spring. Yes, manufacturers are pausing their purchasing, and yes, the threat of new U.S. tariffs is casting a heavy shadow. However, the physical supply of copper in Chinese warehouses is actively shrinking. Plus, major smelters are cutting production capacity because their treatment margins have just completely collapsed. This underlying structural tightness means that the absolute moment manufacturing demand returns, the supply simply won't be there, and Dr. Copper is primed to explode upward. Section 5. Iron ore, grim prospect.
So the crucial point here is, while copper is holding its breath, iron ore is essentially suffocating. Iron ore is one of the worst performing futures right now, having brutally pierced straight through its $100 per ton psychological support floor. It takes an incredibly heavy, bearish market force to break a foundational support level like this. Dropping below $100 puts massive margin pressure on global mining operations, pushing a lot of secondary miners toward unprofitability. Right now, the long-term trend is looking decidedly grim, signaling deep, foundational cracks in global construction.
Let's break down how this builds a massive chain reaction of failure. It all starts with China's severe real estate downturn, which acts kind of like a black hole, destroying steel margins and forcing production cuts right as global mining giants keep pumping supply into overloaded ports. It starts with that freeze in Chinese construction, a sector that has historically been the biggest driver of steel demand in human history. With construction halting, there are no buyers for structural steel. Chinese steel mills then see their profit margins just evaporate, forcing them to halt production and completely stop buying raw iron ore. And the final nail in the coffin? Massive global mining operations in places like Australia and Brazil haven't slowed down their output. They're continuing to send massive bulk carriers across the ocean, sending a glut of supply straight into Chinese ports that are simply building mountains of unused ore. In an environment exactly like this, it is incredibly risky to try and catch the bottom of the market.
And finally, Section 6, Upcoming Signals.
We've seen this massive divide between the golden havens and the rustling industrial engines. But what happens next? Well, the entire market is currently holding its breath for two massive macro triggers. On one side, a dovish Federal Reserve meeting on July 29th that could push gold past $4,300. On the other side, a potential surprise money printing bailout in China to rescue iron ore. A dovish Fed meeting, meaning they signal upcoming interest rate cuts rather than hikes, fundamentally changes the landscape. Lower interest rates mean that holding cash or bonds yields less return, which weakens the US dollar. And a weaker dollar makes zero-yield safe havens like gold much more attractive, clearing the runway for precious metals to reach staggering new highs. Conversely, the only thing that will reverse the downward spiral of the industrial metals is if the Chinese government suddenly decides to intervene heavily with fiscal stimulus to directly bail out their freezing real estate sector.
So, knowing what we've unpacked today about this wildly divided market, which of these two global forces do you believe will flip the script first? Will Western monetary policy push safe havens to the moon, or will Eastern fiscal stimulus reignite the fires of global industry? I really hope this deep dive brought you some incredible clarity today. Thanks for following along with this explainer, and we will catch you next time.